Hello, everybody, and welcome to the Like Totas channel. Happy Wednesday. Não. Hoje é quarta, né?
Sim.
Ok. Hello, everybody, and welcome to the Like Totas channel. Happy Wednesday, dear tortoises. Today, I want to talk about Ulta Beauty and its recent earnings report. They reported yesterday, and in this call, I'm going to tell you everything you need to know about the earnings report in itself and also what happened in the conference call. So I will keep you always in the loop. And if you find this video valuable, please make sure you smash that like button because it really helps the channel. In addition, if you know of someone who might benefit from everything that we are doing right here, please share the channel with them as well. Without further ado, let's jump right into this report. Right, guys. So what's interesting is that immediately after the release, the stock went up about 8%. And since then, it gave back a lot of all of those gains and some more. You can see that the stock is right now down about almost 4% pre-market. The US market hasn't opened yet. It only opens at 2:30 UK time, and so that means it will only open in about half an hour. I'm recording this on June the 3rd, and so we will see. Maybe it will reverse its recent downward trend, or maybe the sell-off will continue. I don't care. I don't really care about that. What I care is about the fundamentals and what I managed to take away from both the report and conference call. As long-term investors, that's always what matters. Right, guys. So what you can see right here, I went straight to Ulta Beauty's investor relations tab, specifically to the presentation report that I'm sharing here with you right now, and you can see that Ulta Beauty announces first quarter fiscal 2026 results and updates fiscal 2026 guidance. So what did we see, everyone? We saw that net sales increased 11.1% year over year. This is fantastic, and they beat. First of all, they beat on sales and earnings expectations. So let me go back right here because I put everything in a document that I will be sharing with you guys. Let me just minimize this, and voila, here's the document. Ulta Beauty delivers strong results, but investors want more. What does that mean? Ulta Beauty kicked off fiscal 2026 with an impressive quarter, beating Wall Street expectations on both revenue and earnings while raising its full year profit outlook. Just by reading this, you would assume that the stock would be trading sharply higher. So what are the key highlights? As I was telling you, revenue grew about 11.1% year over year, which is very solid, even in the face of adversity, because this is what's important, guys. Remember, consumer sentiment is in the gutter. Certainly in the United States, the consumer sentiment latest reading by the Michigan University just showed one of the lowest readings for many decades. You have to bear that into account. What does that mean? Because Ulta sells discretionary items, then it could very well be caught up in this pessimism, right? And they mentioned that the macro landscape is not favorable and that consumers are becoming more cost conscious, and that makes complete sense. So even in the face of adversity, they still managed to grow revenues by about 11%. Comparable sales, ladies and gentlemen, grew by 5.3%. This is a very important metric for those of you who are new to the channel. If you are a retailer, then comparable sales is an essential KPI, key performance indicator, because it tells you how well existing stores are performing. It doesn't account for new openings, it accounts for stores already in existence. Operating income rose 11.6% to 448 million. Very solid operating income growth. Earnings per share jumped 15.5% to 7.74. Why did that jump occur? Because they bought back on top of the On top of the organic net income growth, they added more buybacks. So you can see that they returned 555 million to shareholders to share buybacks. And CEO Keisha Stillman highlighted the company's resilient, here we go, despite a challenging consumer environment. Fiscal 2026 is off to a great start in her own words, driven by broad-based growth across all channels and major categories. We will be talking more about that as we move along in this video. Guidance was raised, as I already alluded to. Management increased its full-year EPS guidance to a range of 28.36 28.80, up from the previous range of 28.05 to 28.55. Revenue growth guidance of 6%, 7%, in comparable sales growth guidance of 2.5% to 3.5% were maintained. So, on the surface, that is absolutely a very positive development. However, investors were hoping for a larger upward revision. Of course, especially those investors who are short-term oriented, they always want more in the short time frame. They are not willing to wait, even if the fundamentals are significantly improving, as is the case of Ulta. The midpoint of the new EPS range is almost identical to the analyst consensus that already existed before the earnings release, meaning there was very little incremental upside surprise. Now listen, there are many reasons why the stock may be selling. Based on a lot of the reading that I was doing this morning, this may be one of the reasons why the stock gave back all of those pre-market gains. Now, were there any other factors? I don't know. And frankly, as I told you, I don't really care. Why did the stock reverse? Initially, the stock surged about 8% after the results were released. Since then, however, the shares have given back those gains and are now trading lower. There are a few plausible explanations for this. Analysts become more cautious despite maintaining positive ratings. Now, one thing that I want to highlight is that going into these earnings reports, the stock wasn't very cheap. And now, granted, the stock had already declined 20% from the last quarter reports because of the growth assumptions already built into the share price going into that quarter. And so several firms lowered their price targets immediately after this report's release, reflecting expectations that increased investment spending could weigh on near-term earnings growth. We will talk about that. But essentially, SG&A expenses increased about 14.6%, largely due to the acquisition of Space NK in the UK, raising questions about how quickly margins can expand from here. In many ways, this looks like a classic buy the rumor, sell the news reaction. The earnings beat and guidance increase helped fuel the initial rally, but once investors dug deeper into the details, the combination of higher costs, more modest guidance upgrades, and reduced price targets prompt some profit taking. Share buyback continues regardless. During the quarter, the company repurchased almost $1 million worth of shares, total value $555 million. The company still has approximately $1.3 billion remaining under its current buyback authorization, providing additional support for long-term per share growth. I love that. My take, everybody, despite the market's lukewarm reaction, I remain bullish on the company. The company continues to demonstrate many of the characteristics I look for in a long-term compounder, of which you should already be aware especially if you have been following me for a long time. But those include, especially if we are talking about retailers, strong same-store sales growth, double-digit EPS growth, consistent share repurchases, healthy cash generation, a disciplined management team. Could margins face short-term pressure as the company reinvests in growth? Absolutely. However, if management can continue executing while expanding the business and retiring shares at attractive prices, I believe long-term shareholders will be handsomely rewarded. More importantly, I continue to have a great deal of confidence in Keisha Stillman and the broader leadership team. Just for context, Keisha Stillman became CEO later in 2025, so she's still relatively new in the job. However, she has been with the company for over 10 years. She knows the company inside out, and in addition to that, she brings a lot of retailing experience. And look, the work that she's been doing at Ulta Beauty is fabulous. And then I will walk you through the presentation, the presentation release that was put out by the company. Management has earned credibility though through execution, and for me that's far more important than how the stock performs over a few days following an earnings report. So if I go right here, let's talk about all the important things that I want you guys to pay attention to. So you can see right here net sales. What else? So I want to talk about this first quarter of fiscal 2026 compared to first quarter of fiscal 2025. What you can see is that net sales, we already discussed that. They increased 11%, primarily due to increased comparable sales, the acquisition of Space NK, and sales from new stores. Now, comparable sales, very important metric. I told you that it jumped 5.3%. And take a look at this, driven by a 3.7% increase in average ticket. What does that mean, average ticket? It means that on average, people are spending more per item. That's what the increase in average ticket means, right? So they are spending more per item, or they are buying. So they are certainly spending more per item, which is very bullish if you are talking about a retailer. In addition, a lot of this increase was also due to a 1.6 increase in transactions. What does that mean? It means that not only are they seeing people spending more per item, but people are visiting the stores more frequently, and so they are transacting more frequently. In other words, they are buying more as well. Very, very good given the macro headwinds that we are facing. Gross profit increased. As you can see, gross profit increased. As a percentage of net sales, gross profit increased to 40.1% compared to 39.1%, primarily due to lower inventory shrink and higher merchandise margin. What does that mean? It means that the profit that the company is taking relative to the direct costs of goods sold is going up, and that's what translated into a higher merchandise margin. So I like to see this quite a bit. And inventory shrink also declined, potentially due to lower thefts or whatever. But this is also very positive. SG&A, as we already discussed, increased 14.66%. This makes total sense because remember, for several years, the company was primarily focusing on the United States. But now they are expanding internationally. So you can see the acquisition of Space NQ, right? You can see as a percentage of net sales, SG&A expenses increased to 25.8% compared to 24.9%, primarily due to the leverage of corporate overhead due to strategic enterprise investments in store expenses, partly offset by leverage of advertising expenses. And you can see if I scroll down right here on the report, where is that number of stores open? Right here. In the United States, they opened about 11 stores. This was for the first quarter of fiscal 2026. They opened 18 stores. They closed 2, so net you have about 16. And then you can see that internationally, they actually opened this store right here. We will talk more about this as well, because the partnership with Space NQ was very smart, because they instead of them they just partner with them instead of opening the stores themselves in the UK, which is very, very good, because it tells you how risk averse management is. So they are expanding cautiously. Okay, so I told you, and then you can see right here, look at this, cosmetics. This is a breakdown of the categories. So they generate cosmetics are by far the highest contributor to revenue at about 40%, followed by skincare and wellness, followed by hair care, fragrance, services, and other. So like that. And yeah, so that's it. This is what I wanted to show you guys. Now let's have a look at let's have a look at stock analysis right here and see what else we can find. So because this is already updated to reflect the latest release, and you can see that revenue grew, right? So remember, we are comparing quarter one 2026 to quarter one 2025. That's where the 11% growth comes from. And if I show you this right here, look at free cash flows as well, also growing despite the investments that the company has been making. In fact, let me change this to quarterly. Much better. So yes, change this to quarterly. Yeah, so I was checking the annual, which is wrong. I want to check the quarterly. And yeah, so you can see that. And if I show you this right here, where is that? Operating income, right here. Okay. So big jump, even against the backdrop of higher selling, general, and administrative expenses. We still saw a surge in margins. In fact, if I show you, I can show you this right here, right? So look, if we compare quarter one 2026 to quarter one 2025, you can see that growth margin was initially 39.12. Oops, sorry. Well, 39.12 right here, and now we are at 40.7. So there was here some margin expansion, which is very constructive. And look at the operating margin. It was 14.17 versus 14.11 same quarter last year, even though the company has jacked up its operating expenses. This is all very constructive. And if you look at the profit margin, look at this, guys. 10.81% versus 10.73%. Remember, margins are always a percentage of revenue. So the higher the margin, the better, because it means they are translating more revenues into core profitability. Certainly, if we are talking about profit margin. And then, of course, you have the free cash flow margin, which shrank exactly because of the investments that the company is making. And if I show you right here the cash flows, and you can see, for example, if I go to CapEx expenditures, take a look at this. There was this massive jump in January 31st. Now it's come in since then, but CapEx, so overall on a trailing 12-month basis, certainly remains pretty high. So let me do that right here. CapEx, yeah, you see. So it remains very high. So, and because they are doing a lot of international, they are expanding internationally, which is exactly what I want to tell you about right here in the presentation release that they gave. So this, we already discussed that, but now let's talk about some things that make me feel even more bullish going forward. You can see that they launched the TikTok shop, which positions Ulta Beauty at the center of discovery and enable them to build influence with younger consumers. All younger people are certainly Gen X are all on TikTok. I'm certainly not one of them, but perhaps I should change my mind later on, but not for now. But this is something very nice to see, right? Because it gives them another vehicle for expansion. And you can see balanced approach to newness is driving consumer excitement across key categories, launched 20 plus new brands during the quarter, and look at their loyalty program. This is one of the reasons I got into this company initially, was because their loyalty program is just so sticky and continues to increase. And the big chunk of their revenues come directly from this loyalty program. Look, up 4% year over year, already representing already including almost 47 million members, which is incredible. And this is scale new attractive businesses. This is what I wanted to talk to you about. Expanding internationally, expanding international presence with new store openings across markets, including the grand opening of Madero store in Mexico City and the Dubai Mall location in the UAE. Building marketplace assortment with 325 plus brands and 8,000 plus SKUs at quarter end. Uh, all of this is, of course, very, very good. I like that, and it's already translating into strong into strong numbers. Our Ulta Beauty Unleashed plan is delivering results. The Ulta Beauty Unleashed plan was a plan that was kicked off by Keisha Stillman when she became CEO at the end of 25 in hopes of turning this company around. Because remember, at the time, the stock was down almost 50% from its previous all-time high, and so boy, has she delivered, and in just a short amount of time, which is incredible. And we remain confident in the resilience of our category and the strength of our model, which we believe will create compelling value for shareholders. So I like to see that quite a bit. This is the CFO. And if you want to read more about that, you can then go to the investor relations section on Ulta Beauty's website, and then you can just download the earnings report and also the. You can download the report that they filed with the SEC, and also the presentation report that I'm showing you here right now. So guys, so the question that we are probably asking right now is the company right now already is the company expensive, or do I think that the company still trades at an attractive valuation level? That's what I want to talk to you right now. I went ahead and calculated the intrinsic value for the company using Phil Town's 3 valuation methods that I discuss here at length. So if you want to know more about those metrics, you can just go back to some of my previous videos. And typically, whenever I talk about valuations, I always go through these 3 methods. Now, you can use them in combination. That's probably best. But what I have to say is, unless you are talking about a high growth company, and that is not really the case with a company like Ulta Beauty, then using the margin of safety valuation method won't make a lot of sense, because the intrinsic value that you will get, so the intrinsic value is 345 according to this method, and this of course is low exactly because the growth that is the projected growth is also low. So if the company is growing at 15% or above, then the margin of safety will do them justice. But that is not the case for a company like Ulta. In fact, analysts used to be more negative. Now they are projecting around 11% EPS growth over the next 5 years and beyond. I use 10% to be conservative. And then the default PE is always twice the growth rate, which is 20. But you can see that if you use 10, then your default PE will be 20. And this will cause the intrinsic value to be much lower compared to, for example, a company that has a 15% growth, and then that will mean a default PE of 30. So I hope that makes sense. The margin of safety is best suited for companies growing at 15% or above. So I'm not going to pay attention to this method, but what we can see right here, let's talk about the payback time in the 10 cap rate. And you can see right off the bat that the margin of safety, right? So because remember, the payback time in the 10 cap rate all have a 50% margin of safety already built into these calculations. And so does the margin of safety price, right? So if we calculate the intrinsic value if we calculate the payback time at 316, that means the payback time is 316 times 2. That's over $600 a share. I hope that makes sense. So payback time, how do I calculate that? You start with the company's last 12 months free cash flow right here. And then you're going to grow the free cash flows at our projected 10% growth rate for 10 years, for 8 years. Why? Because I think as a business owner, and my goal is to recoup my investment in no longer than 8 years of free cash flow. So in no longer than 8 years. And so if you do that, so if you compound that free cash flow, so we start with the initial free cash flow, we grow it at 10%, and then you add up all the free cash flows, and you get to a cumulative free cash flow number of about 14 billion. And if you divide that by the number of outstanding shares of the company, which is 45 million, that gives you a free cash flow 8-year payback time price of $316 a share. What does that mean, guys? It means that if you want to recoup your investment in no longer than 8 years, and if you believe that the company can grow free cash flows at 10% per year over the next 8 years, then you shouldn't be paying more than $316 a share. What do we know? We know that the market price, we know that the share price is currently at 494. So we don't have that attractive margin of safety, right? But remember, according to the payback time, the intrinsic value of the company is 600, right? $630 a share, because we do this divided by 2, then that's $630 a share. So at 494, we still have some margin of safety, but it's no longer as attractive as it once was. Certainly not when I started buying shares, because my cost basis is much lower than the current share price. I want to be clear. Now, one thing that we have to understand is compare the difference between the free cash flows, right? The current free cash flows of about 1 billion. Let me zoom in on this. Can I do that? Yeah. Compare the difference between the current free cash flows and the current earnings. There is a difference, and the reason is they are investing in growth, which is depleting the free cash flows a bit. So if you do earnings instead of free cash flows, of course, the earnings 8-year payback time price is higher, and it's around 332. Okay, but anyway, over time they should converge, and the difference is not that big. So I would settle for the free cash flow 8-year payback time price. Now let's do the 10 cap rate, which is the most conservative one if you ask me, because it does not include any growth assumptions. So we start with operating cash flow. We find the total capex, and you can find that by going to the cash flow statement in capex, and then maintenance capex, if you don't find it in the annual report, is typically between 50 and 70% of capex. So I mentioned 290, and then you add the tax provision that you can find on the income statement. And if you do the operating cash flows minus the maintenance capex plus the tax provision, that gives you the total owner earnings. And then if you divide that by the 45 million shares outstanding, you get owner earnings per share of around 36.36. And if we multiply that by 10, then we get an owner earnings per share so we get a 10 cap valuation price of around 363. Why do we multiply that by 10? You have to understand, once again, go back to my previous videos, but you can see right here that we want to buy this company, this or any other company, at a 10% yield. In other words, so a 10% pre-tax cash yield. In other words, you are earning 10% on your money and would recoup your entire investment in about 8 years, even if the business never grows. That's the logic behind the 10 cap rate. So 363 is the price you would pay, and if the company does not grow going forward, theoretically you will recoup your investments in 10 years at the current growth rate. So I hope that makes sense. And you can see that 363 is not that far off from the free cash flow 8-year payback time price of 360, which is exactly what we want. The closer they are, the better. And according to the 10 cap rate, what you know is that the intrinsic value of the company is around, what am I doing? 363 multiplied by 2, that's 726. So you also have a margin of safety right now because the company is at trading at about $500 a share. However, it's no longer as attractive as it used to be. So guys, we already determined the intrinsic value. We know that it sits anywhere between 632 and 726 a share, and we know that the margin of safety entry price would sit anywhere between 360 and 316, which means that I certainly wouldn't be adding to my position at current levels. However, if the company continues to sell off unwarrantedly, then so if it continues to sell off indiscriminately, then I would more than happy to add those shares because I think what's lying ahead is very, very bullish. Okay, I hope that makes sense. In addition, guys, take a look at the financials of the company. I always do that. So this is my intrinsic value calculation full model template. On the left hand side, you can see the main line items across financial statements. And on the right hand side, you can see the most important calculations. For example, you can see how capital intensive this business is. CapEx as a percentage of sales sits at 2%, which is very good. I like this to be under 5. CapEx divided by CapEx as a percentage of operational cash flow sits a bit higher than I would prefer. Anything below at or below 15 is good, but I understand the cycle that the company is in. That said, anything below 20 is fantastic, so it's pretty much aligned with what I would like to see. In addition, take a look at the debt levels. Fantastic. All right, so this company is very, very strong. They generate a lot of free cash flow, very healthy balance sheets, and this is a company, everyone, that boosts very strong returns on invested capital for a retailer, which is even more staggering. So if I go here to the ratios, you can see Royce. Take a look at that. Now, granted, it has come down, all right, which coincided with Stillman stepping into the big role, and you can see what's been happening as of recently. It's rebounding ever so slightly, and this is very good. So even though if despite the decline, you are still talking about 22% returns on invested capital, which is absolutely insane. Okay, so I like to see all of that. In addition, if I show you statistics right here, they will tell you that the company has a net debt position. So yeah, they have a net debt position. But what I want to highlight is that this is not bank loans. So let me show you what that means. If I go to the trailing 12 months balance sheet, what they have, guys, is long-term leases. And stock analysis treats long-term leases as long-term debt. All right. However, they are not the same thing because the company doesn't have interest payments on any debt. So long-term, that's why if you go to another stock analysis platform like Stock Unlock, they will tell you that the company actually has a net cash position, precisely because they don't see leases as debt. Okay, so it's one thing to have long-term leases, another thing to have long-term debt, like bank debt. I hope that makes sense. And yeah, so let's have a look at something else that I think you guys should be paying attention. I think I already covered a lot of the stuff that I want to cover. So yeah, I mean, look, debt as even when you account for those leases, even if you treat them as debt, which they are not, you can see that the company could pay down all of that within 2 years of current free cash flows. This is fantastic. Okay, gross margins pretty solid. Excuse me, and sure enough, you can see that the weighted average cost of capital is about 8% with a ROIs of about 26.13%. The economic spread is very, very appealing for an investor like me. All right, guys. So this is everything that I wanted to share with you. Very constructive on this business. The market just opened 3 minutes ago. Let's see how the stock. Oh, okay. So I already have the answer. You can see that the stock is now down almost 6%. Let's see if the sell-off continues. Yeah, so that's it. Thank you guys. Make sure you smash the like button. Let me know in the comments if you are an investor of invest in Ulta Beauty. Yeah, let me know if what else you would like me to analyze, and I would certainly make a note. Thank you so much, and don't forget, be a tortoise.